Okay, this is video number 2 for investments for chapter 1. We'll start with the investment process. So a portfolio, first of all, just so we know, is just a collection of your investment assets. So the group of everything that you've invested in effectively. When we talk about asset allocation, the primary determinant of a portfolio's return is how we allocate the assets that we have. And a lot of times the first thing we do is we allocate based on risk and need, what types of assets we're going to invest in. For example, we have, I don't know why that went away. Sorry. Something's wrong with the slideshow. I'm going to escape here so you can see what I'm talking about. So we have equity, bonds, and bills, VT bills. Now, within these categories, there can be different risk factors as well. But generally speaking, T-bills would be the lowest risk factor and generally the lowest return. Equity would be generally the highest risk factor and generally the highest return. Bonds would be generally the middle of the road risk factor and middle of the road return. So generally, we start with our investment strategies when we talk about what our asset allocation is going to be. And this is just 2 examples of different methods of investing and different risk structures in general. Okay. Next, we go to security selection. So the decision security selection is the choice of which particular securities to hold within each asset class. So now we've got our classes. We know what percentage of stocks we want versus percentage of equity versus bonds versus bills, but which ones do we want? Okay, specifically what equity, specifically what bond, from what company, what grade. So choice of those securities within those asset classes. And so we have to look at the securities themselves and see what the value of those securities are. So a top down starts with assets and then goes into the security analysis, and a bottom up starts with security analysis and then backs into their asset allocation. All right, risk return trade-off. So actual or realized returns, I'm going to start over. Financial markets are really competitive. So you're looking at people who are continuously analyzing and looking at stocks and estimating what they think their return is going to be and all that kind of stuff. But if we assume there's an efficient market, that would mean that generally speaking, returns should follow a risk-reward trade-off. The higher the risk, the higher the reward, and the lower the risk, the lower the reward. So assets with higher than expected returns have a higher risk. In stock portfolios, lose an average of 25%, which I think is crazy. That number seems off to me, but you notice average annual return, and this is, I believe, for the S&P 500, if I remember correctly, is 12%, but then we also have some years that are really big swings. These are the biggest swings within a year on the S&P 500. 1931 being there in the Great Depression, and this 1933 when we were starting to come out of the Great Depression. So that makes sense that those years are on there. Bonds, on the other hand, have a lower average rates of return, usually under 6%, but have not lost more than 13% of their value in any one year. So you see that makes less risk, right? We got a lower return, we got 12% versus 6%, but has lost no more than 13%, where you have some years where we've lost 46% in the equity section. So that shows you right there that bonds are less risky and also in general less return. And this is just aggregate for, years and years of the S&P 500 market. So how do we measure that risk, and how does diversification, help with that risk or aid in mitigating that risk? So if our market is efficient, and you can look up a paper, one that I've read not too long ago by Harry Markowitz, and there's also one by Harry Markowitz and William Sharp, and it talks about modern portfolio theory. If you go type that in, or even their names into Google Scholar, you'll find that article. And it talks about diversification. And when we talk about diversification, we're talking about that we can limit exposure of our assets if we balance our assets through diversification. So for example, there are a lot of businesses that have an inverse relationship with the economy, and there are also businesses that have a direct relationship with the economy. Example of a business that has an inverse relationship with the economy. Inverse relationship with the economy would be a a liquor store. Okay, alcohol sales go up when the economy is going down. Okay, that's a very common economic event that occurs when the economy is not doing well. Alcohol sales and a lot of vice sales of things that would be considered vices are usually doing well. Same thing with a mechanic shop, auto mechanic. People are less likely to buy new cars when the economy's down. They're more likely to buy new cars when the economy is up. So mechanics are busier when the economy is doing poorly because more people are fixing their cars rather than buying new cars. You can also have businesses that have a direct relationship with the economy, where when the economy is doing well, when investments are doing well, that company is doing well too. So in addition, if we assume an efficient market, then securities should be neither underpriced nor overpriced on the average and reflect all information available to investors. So if you believe in the market efficiency, then you have your choice of investment management style. So if we assume that the price on a stock is correct and fair, then you can have a choice between two different types of management styles in your investment portfolio. Passive management, you assume that they are efficient. You assume markets are efficient. You attempt to find undervalued securities, and there's no attempt to time the market. So if you assume the market is efficient, you are buying stocks that you think that are just, are worth more than what the stock market says they're worth. Whether that's because you have additional information, whether that's because you have additional knowledge or skills in some way, whatever that is, you're looking for something that is undervalued, and there's no attempt to time the market. So this would be more long-term investments, okay? Companies and organizations you believe in and invest for a long time. Whereas active management, you believe the markets are inefficient, you actively seek to find undervalued stocks, and you're trying to time it. So this would be your day traders, your penny stocks, those types of things, where you think you can find something and sell it quickly with a quick turnaround and make a fair amount of money. If you believe you can do that, then you believe the markets are inefficient, not efficient. All right, the players in the investment financial markets. Businesses, the firms. The firms are the net demanders of capital. They're the ones who borrow and get capital from other organizations. Households, on the other hand, are the suppliers of capital. They're the net savers. Okay? They're the ones that are putting money into the market, whereas the firms are the ones receiving money from the market. Governments can be both borrowers and lenders. They do both borrow and save. And then we have the financial intermediaries, which is the connectors of borrowers and lenders. So they're the ones that set up the deals between the business firms and the households. They're the ones that we make and buy stocks through in order to invest our securities, invest our money. Examples of those: commercial banks, investment companies, insurance companies, pension funds, and hedge funds. Okay, so the price of capital, the quantity of capital, and who supplies and who demands the capital. Well, who supplies the capital? We just talked about it on the last slide. Households supply the capital. Who demands the capital? Firms. Okay, and what's the role of government here? Well, the role of government is hopefully to help that equilibrium be reached. Generally, we're talking about doing this through regulation. So we're looking for supply to equal demand as much as possible, which creates a smooth economic foundation. All right. Investment bankers. Investment bankers are firms that specialize in new securities like IPOs or primary markets. So when a company first goes public, that's called an IPO, and their initial public offering, they offer their stock. That is the primary market. That is the only time that businesses actually receive money from the sale from that investment. They do not receive money when you buy it on the secondary market. So the primary market, when there's an underwriter and the investment bankers, that's when Google or Apple or Walmart or anybody that you want to name receives the actual money from it. Business actually receives the money. Where The secondary market is the one that's more common. In the secondary market, you're buying it from someone else who already owns it. So if you go right now and want to go buy a share of Apple or Amazon or Walmart or Target or any stock that you want to buy, most likely, unless they are currently offering new stock, you are buying it from someone who already owns it. That is a secondary market, and those companies are not receiving any of that money. The person receiving that money is the investor that you are paying for that stock. Investment bankers are separate from commercial bank functions by law, and up until 1999. Post 1999, large commercial banks increased investment banking activities. In September 2008, the mortgage market collapsed. We had a recession, and there were major investment banks bankrupt that were purchased and reorganized. There was a lot of shifting after all of the financial crisis that occurred in 2008. We're going to talk about that a little bit more in detail. Investment banks can become commercial banks if they obtain deposit funding and they have access to government assistance. Generally, talking about something that's FDIC insured as well, which is where that government funding comes in. And they have to have deposits, and they also have to insure those deposits. And major banks are now under stricter rules. Ever since 2008, there's been several different laws passed, but Frank Dodd is the big one. We'll talk about that one in a few minutes. So this is the balance sheet of commercial banks. Notice that commercial banks' real assets is $125 billion, whereas their financial assets is $15 trillion. They have a lot more in financial assets than they do real assets. They have 1,000 worth of intangibles as well. But the vast majority of assets on a commercial bank is in financial assets, not in real assets. As you can see, it's 93% financial assets. Whereas a non-financial, like business, so regular business is not a financial institution, it's not quite completely flipped, but you can see it's completely different. 54% is in total in real assets, and 46% is in financial assets. So financial institutions are heavy on the financial asset side compared to the real asset side. Whereas regular businesses, just any other business around the United States, is about half and half. Okay, venture capital and private equity. So venture capital, these are equity investments to finance a new firm. Venture capital usually is a group of people who get together and want to invest in businesses. Think of Shark Tank, except for think of it in a group setting, where you're pitching your idea to a group of investors and they pool their money together. And that's the whole purpose of a venture capital firm, is just to invest in new businesses. A lot of times before they are, sometimes it's when they're public, but also it can be when they're still private. So private equity is investments in privately held companies, so companies that are not publicly traded. So, one of the largest companies in the world that's not publicly traded is in Wichita here at Cook Industries, which is a privately held company. That's a very large privately held company. All right, so since 2008, there's been changes since the financial crisis. They've made changes, both through laws and otherwise, as to how we handle loans. So the way that it was, we had local thrift institutions made mortgages loans to homeowners. Thrifts possessed a portfolio of long-term mortgage loans, and thrifts maintained the liability of the deposits itself. The new way, securitization, Fannie Mae and Freddie Mac bought mortgage loans and bundled them together in large pools, and mortgage-backed securities can be tradable against the underlying mortgage pool. It didn't come up on here. It's messing up. The slideshow's messing up again. But this way, the old way, they originated the loan so they could hold on to it, and this way, they originated the loan so they could sell it. So here's the cash flow of the mortgage process through security. So we've got the homeowner, we've got P&I, which is the principal and interest, and then the servicing fee and the servicing guarantee fee, and that goes to the investor. And the bank itself, the home itself, or whatever it is they're purchasing, is owned by the homeowner eventually once they pay down all the P&I. It is secured with, it's secured with the house itself, if it's a house that you're purchasing, where if you don't pay the loan or if the liability goes bad, they will, take the house and sell the house. Other changes in finance, inclusions of non-conforming subprime loans. This is what was happening before 2008, by the way. They had subprime lending, a lot of subprime lending. Low to no documentation loans, where it was just like a signature loan, where there wasn't really much documentation to back up the fact that they were doing it, and also not very well secured. Rising loan to value ratio, where the loan was increasing in value at a faster rate than what the secured asset, if it was a securing asset, was rising. So effectively that made you upside down almost, really quickly in the loan, meaning you owed more than the value. And then ARMs, adjustable rate mortgages, where you would start out at a given rate, but the rate would go up or down based on, could be based on a lot of things, could be based on the banks themselves, could be based on prime rates, could be based on a lot of things, but adjustable rate mortgages versus fixed rate mortgages. All right, this is a Case-Shiller index of housing prices, and you can see the steep climb from about 98 all the way through 2008, 2006 or 7, and then you saw the drop. So what ended up happening really, because loans and money was becoming so easy to get, that banks were allowing people to overextend themselves. They were letting people buy homes they really couldn't afford, and then the value of those homes would rise. But a lot of times the mortgage would also, if it's an adjustable rate, the interest rate would also rise. And so people got into real trouble, and they were buying homes that they couldn't afford, and banks were allowing them to, because there was low to no documentation, and they weren't really as worried about securitization as they should have been. There's also mortgage derivatives. And derivatives, by definition, means that it derives its value from somewhere else. So, like the subprime loans, people bought and sold those. Those would be derivatives. So CDOs, consolidated default risk of loans, onto one class of investor, and they divided the payments into tranches. And the rating agencies also paid issuers and pressured them to get high ratings. So that's just something that's, I think, illegal now, but where the issuers of the loans would ask the rating agencies to rate people's credit scores higher than they should have been, so that they could qualify for a loan that they really probably shouldn't be getting. Credit default swaps, insurance contracts against the default of the borrower, where they would have an insurance policy that the borrower would not pay, and they would receive money in return if they did not. So they would have their insurance money that was paid. The issuers ramped up risk to unsupportable levels, where they got to the point where they were lending so much money to so many people who could not afford the loans. That's when the whole crisis kind of came down. So it's the AIG, themselves sold $400 billion, and that's one insurance company sold $400 billion for the CDS contracts. Okay, systematic risk. The risk of the breakdown of the financial system, the spillover effects from one market into others. Banks were highly leveraged. Their assets were not very liquid, so they had very little cash. Most of their leveraging was in actual real assets like property, which is, nice because it's real, but it's hard to, when it's less liquid, then that means getting the actual cash out of them takes more time, substantially more time. So, and then formal exchange trading was replaced by over-the-counter markets where there's no margin for insolvency protection. So where there was a formal trading before, now we didn't worry about the potential for insolvency at this point. Again, this is before 2008. So when the shoe dropped, September 7th, Fannie Mae and Freddie Mac were put into a conservatorship. Lehman Brothers and Merrill Lynch were both on the verge of bankruptcy. September 17th, government lent $85 billion to AIG, and the money market panic froze the short-term financing market. So basically all the money locked up. When the shoe dropped, not only was the government giving out loans to companies, there were several large companies about to go bankrupt, but also it made banks say, wait a minute, we don't have any money to lend anymore. So it froze up the ability for people to get loans in the first place, which in turn freezes up the economy. So this is a LIBOR, T-bill, and TED spread. Sorry. And this was back on page 16. Yeah, so you can see that the LIBOR, which is a London interbank offer rate, so it's the rate that they're lending in London, versus the T-bill rate, which is the rate that, you know, we're paying on T-bills, which is real close to the prime rate, which is the federal government's rate for the Fed. You can see that a gap, there was becoming more and more of a substantial gap as we approached the economic turmoil in 2007, 2006, and 2007. Dodd-Frank Act made stricter rules for bank capital, stricter rules for liquidity and risk management, mandated an increase in transparency, clarified the regulatory system, and also created the Volcker Rule. So the Volcker Rule limits the bank's ability to trade for its own account and to own or invest in hedge funds or private equity funds. So they couldn't, they're basically saying you can't get kickbacks. So you can't have people say, hey, if you invest in my firm, then we will give you X percentage of this trade. It created a fiduciary responsibility effectively where banks had to act on the behalf of their clients rather than on their own behalf. This is a cumulative return on $1 investment from the S&P 500 from 1980 to 2016. And you can see that, you know, there's obviously bumps in the road, but overall it's a trend up. But you can tell when things are not going well. So the internet bubble crisis, the recession here in 2006, 2008, and then back up through today. Okay, and that is it for chapter 1. So we'll stop there.